Joining in on the show is P. Fanish Shekhar, Fund Manager PMS at Angel Broking, who now joins in on the show. Fani, thanks very much for being with us. It's been a market that has been fairly tired over the past many weeks. Are you seeing a little bit of a rally prior to the budget?
Good afternoon. The market seems tired and the reasons are not difficult to decipher because if you look at the valuations, they are no longer as attractive as they were maybe 6 months back. Since September, you had a slew of reform measures that were announced, and all this while you had a healthy global liquidity, which have helped us reach till this point in time. Even the positives emerging, which potentially might emerge from the budget, are more or less factored in by the market because the finance minister, in a way, has been assuring global investors almost on a daily basis that it's going to be a responsible budget, and next year's fiscal deficit target is to be around 4.8%. Now, how he reaches that will be analyzed in detail after the budget. But till the budget, I guess the element of surprise has positive surprise more so has more or less been taken out. So to that extent, it again comes back to what valuations are we trading at, and is there any room for upside in any of the segments. So that explains why after the initial rally, large cap IT, which surprised the markets, or private sector banks which gained significantly after good results, and in some pockets PSU banks after gaining after positive surprises, are now showing you a very flat trajectory. I guess this trend will more or less continue for at least one and a half month, closer to not just this budget, but maybe going into the fourth quarter results, and then investors will take a relook at what's the outlook for FY14.
Right. Now, Fani, looking at the Q3 earnings season on a broad basis, would you say it's coming better than what you may have been expecting?
Yes, and that's primarily because of a surprise in large cap IT, private sector banks being more resilient than what we thought, segments of PSU banks having shown better results, and very importantly, although oil and gas might not reflect good results just this quarter, but the policy measures initiated in that sector certainly have led to a major boost in sentiment, and the results will follow from the fourth quarter onwards. So all in all, it's certainly a positive surprise both in terms of the absolute numbers and the sentiment.
Fani, what's your view on the overall banking space in terms of the numbers, particularly Bank of Baroda, which put out a disastrous set following Punjab National Bank's numbers also, which were fairly abysmal. Do you think that the asset quality concerns are likely to linger for some time now, as the management has also indicated?
Asset quality concerns will continue for at least another 3 to 4 quarters. It's too early for us to start writing off asset quality concerns on the back of reduction in interest rates. Because we cannot wish away the kind of restructuring that has happened in the economy over the last 18 months or so, especially in the last 4 quarters. And since predominantly you have a 12 to 15 a month moratorium for many of these restructured assets for a banker to figure out whether they have become normal or not, in the sense that they start servicing you principal and interest in some cases. It is only now that you will actually come to know, starting now all the way up to December this calendar year, whether the kind of restructurings that you entered into over the last year and you are currently entering into, how successful were those restructurings. So to that extent, I think over the next 3 to 4 quarters, you will see incremental slippages which will continue to surprise the market on the negative side. This is especially the case with PSU banks. Private sector banks, however, because of their more of a retail orientation, might escape this.
If we talk about the liquidity situation, DII is clearly shying away. We've seen the biggest selling in the month of January since October 2010. They've sold equities of nearly 4,550 crores. And on the flip side, you've got FIIs which have been buying into the equity markets with quite a bit of conviction. What do you think it's going to take to see the DIIs also put their money and have faith in the stock markets?
Well, I guess DIIs are not doing out of their own volition, but the retail investors are forcing their hand. in the form of redemptions. The inflows both from insurance and mutual funds have significantly been curtailed, not just because of the retail investor sentiment, but because of the regulatory changes that we saw in the industry. And overall, because as the market has reached that psychological mark of around 20,000, it's natural for many investors who have had not so pleasant memories of this mark maybe 4 or 5 years back. And again, when the market attempted this in November 2010 to come back and offer their shares for their mutual fund units or ULIPs for sale. So this is a natural process, and I think it will take another 2-3 months for this to be cleared out. And once investors figure out that this particular rally is for real and fundamentals are strong, they will slowly and steadily come in. And once the market crosses the all-time high and stays there, there is going to be a rush of investments into equities. But that might be 6 to 9 months away.
Are there any turnaround stories that you're expecting for the remainder of the year, particularly some of the beaten down infrastructure names that we might see some strong potential in?
No, I'm not expecting turnaround, because turnaround in this particular macro environment in which you have many of the distressed companies getting there in the first place because of high debt would mean that you will have a turnaround in the macro environment. So a turnaround in a specific company is difficult to map. And I don't see a turnaround in the macro environment only because interest rates come down by 50 or 75 basis points. You will not have people restarting the investment capex, because there are issues with investor confidence out there. And more importantly, since the elections are just around the corner in 2014, April, May, you might see that fresh investments in mega projects might be delayed. What is, however, more important is the restarting of the projects that have already been initiated a couple of years back. Even if that happens, then I think that there will be some relief, but a turnaround might be just too strong a word to use.
That's funny, we also had the auto sales numbers for the month of January out over the weekend. How are you viewing that? And again, what's your outlook for autos going forward?
Autos have had a dream run over the last 2 quarters. This despite the tepid outlook for them both in the two-wheeler and the four-wheeler segments. That rally was mainly predicated on a reduction in interest rates. Now there is no element of surprise, because the market has already built in a reduction in interest rates and a consequent increase in volumes in many of these stocks, and what is coming out is as per expectations. So while you might have two-wheeler stocks which might not fall meaningfully, but any appreciation from here is difficult to map, because volume growth is a big issue for them. As far as four-wheelers mainly led by Maruti are concerned, that rise was mainly on back of currency depreciation, and these are dangerous things to start investing into, because that can quickly reverse. So I think the investors broadly understand that, and to that extent you are seeing that there is no significant appreciation in any of these stocks. So I guess they might be in this zone for some more time until the outlook on volume growth improves significantly. You may not see investor interest return back to them in a big way.
Pani, before we let you go, what is your sectoral preference and any particular stocks that you'd advise?
We have been liking private sector banks for a very long time, and we see no reason to change that view. So within that space, Axis Bank and ICICI Bank are our top picks. Within the mid-cap space, we like the print media segment, that entire gamut of agri-related inputs ancillaries, which means tractors, fertilizers, and rural consumption plays. Housing NBFCs like LIC Housing Finance and GIC is something that we like. So we are sticking to some of the old economy spaces, brick and mortar businesses that you call, and not playing so much for the turnaround.
Thanks very much, Fani, for taking time out and joining in with your fundamental perspective on the equity markets.